Thanks everybody who's thanks everybody who's joining in here. We have a few more coming in. We're going to give them a few minutes before we start, so just hang tight. Well, welcome everyone. I want to thank you for joining us today's event, our launch with Localvest. So my name is Jake Dooley. I'm the CEO, and I'd like to thank everyone who's logged in and listening today. Localvest is the largest network of investors who want to invest in veteran-led companies. So whether that's a real estate opportunity, early stage startup, or a fund, this is the place to go if you want to invest in the veteran-led space. A little bit about how today is going to work. So this is a Zoom webinar. So that means you can see us and hear us, but as attendees, we cannot see or hear you. But the chat is live, so you can go in there. You can type any of your questions or comments that you have. We have people who are monitoring. We put some links in there as well. So if you have a question, put it in there. As we go, we're going to have two companies today, roughly split in half. And so as we hear from them, I'm going to ask some questions of each of them at the end. I'll take some of your questions as well, if some of them make sense. But if we don't get to them, again, put them in the chat. I'll be able to save those, and they'll be able to go back and answer those questions for you. We do have some polls along the way as well to spice things up, so you can go and answer those questions. Please fill them in as you wish, answer them, and we'll be able to respond to those as well. And with that, we'll go in. We have two incredible companies today with us today. I can't wait to hear some of the really neat things that they're working on. They're two very different companies, and I think you'll enjoy the conversation that we have. So without further ado, let's get things started. So today, our first company is MAG Capital. So Neil Walgren is here with MAG Capital. Neil brings 2 decades of leadership in operations and capital markets. Prior to joining MAG Capital Partners in 2019, he led a Bay Area real estate investment firm, which facilitated the acquisition of about $500 million of income-producing commercial real estate. He is a graduate of the U.S. Air Force Academy, and he is a C-130 pilot, both the Air Force and the Navy, with 2,500 flight hours with combat tours in Iraq and Afghanistan, and he finished up as a lieutenant commander. And with him today is MAG Capital's Vice President of Investor Relations, and that's Drew. And Drew's focus is primarily to manage the new and existing equity and lending relationships. So he also joined MAG Capital in 2019 after 8 years as a risk analyst and a program manager at Liberty Mutual Insurance. And he's built systems that pair real estate properties with well-suited financial instruments. And he's bolstered the equity relationships in order to quickly assess capital for time-sensitive acquisitions. So both of them are going to tell you more about that project, but I'll turn it over to Neil now.
Okay, thanks, Jake. Hi, everyone. Neil Walgren, partner at MAG Capital, and Drew and I are excited to introduce our firm and also our current live investment, which is the MAG CP Industrial Fund II. And we'll open this up for questions afterwards. Just a quick high level on the firm. The firm was founded by Dax Mitchell and Andrew G back in 2015. Dax and Andrew are both career commercial real estate brokers. So really they handle the buy sell side with a unique focus in industrial single tenant net leased real estate. So Andrew focuses on the really the analytical and underwriting side. So he also has a 10-year commercial real estate appraiser in CCIM. And Dax comes from a real estate family from Fort Worth, where a firm is founded. So the Industrial Fund 2, this is our second diversified industrial fund that we're raising capital for and deploying into really what you see here. It's going to be a selection of Midwest-focused industrial steel-sided warehouse real estate. So with Mag Capital, we are the fund manager. This is our second fund. First one we launched back in June of last year, fully deployed across about 150 million in real estate, and stabilized it and closed it in December. So Fund 2 here launched in mid-February. We're on the early stages of deploying, and our third property in that is closing this week. So we talked about the leadership. Mag Capital is fully vertically integrated. So Drew and I run a team of equity and debt personnel where we direct source our equity and debt for these investments. We also have in-house credit risk advisory, a full in-house team that does a deep dive into the credit on each tenant. We have construction facilities management for development and capital projects, along with a full investor relations and asset management team. Kick over to Drew if you want to take a look at our track record to date.
Yeah, thanks, Neil. Drew Walgren here. Great to see you all. Yeah, as the map really here, it shows where we invest, and we are a little agnostic as we're investing, but where we find a lot of the opportunities are heavily in the Midwest and in Texas, and more in the Southeast, as well as the West Coast here. But, today we've gone full cycle on 44 properties where we've brought in equity, cash flowed and sold and returned capital and profits to investors who've joined us. But today we own and manage about 655 million in assets under management, which is primarily industrial real estate. And going back to the exits of those, on average, we've returned 20% average annualized return to our investors. Neil, I'll let you take it to the next slide.
Awesome. So, before we dive into the specifics of the fund, I always like to back up a little bit and go, why are we investing and purchasing industrial real estate right now? So for those who have been watching the financial markets, it's not a surprise interest rates have increased over the last 10 months. In our business, cap rates have also climbed correspondingly. So what that means is for the same purchase price of a property a year ago, that same property today is delivering a significant higher amount of cash flow. So that increased cash flow, even with the more expensive price of debt, that spread provides our yield. That yield ultimately helps us deliver in the first year approximately a 7 to 8% cash on cash to investors. And that's going to be really locked in with a 20-year absolute triple net lease. So because we're still able to get that spread at a very low basis, we find this is one of the better times for acquiring industrial real estate that we've seen in the last 10 years. This is a continuation on what we've done really since inception of our company. Ultimately, we did individual projects for a very long time and switched to a fund model a year ago. And this is the second fund that's really a continuation of that progress. And then ultimately, each property that we buy, we're putting in a long-term, typically 20-year triple net lease. And that triple net lease is going to completely shield our investment team and investors from any expenses. So our tenants are paying their own insurance, taxes, and all building maintenance. And lastly, how we acquire these. Ultimately, our competitive advantage is going to be sale leaseback, where we actually purchase the real estate from owner occupants and lease it back to them. Because of this niche acquisition focus, we're able to get substantial off-market deal flow in a way that keeps us very competitive as a team. Drew, you want to talk the specifics of the structure here?
Sure. Yeah. In the fund model, we're really deploying this $60 million in equity across the first 6 to 8 months, but conservatively looking at the first year to deploy capital, purchase these cash flowing industrial assets. But really years 2 through 4, we're enjoying that cash flow and really getting a compounding return here as as lease rates continue to bump up gradually every year. Cash flow increases to investors, and we're going to sit back and enjoy that, getting passed through depreciation to offset the tax liability. So really, as you get towards our year 6 exited target, years 4, 5, 6, we're going to start looking at taking dispositions depending on the market conditions at the time and sell the assets and return capital and profits to investors. So as far as a fund goes, part of the reason we move to this model is really diversification, right? That's going to be the number one most obvious reason to move into a fund model. But we have single tenant assets. So it was really important for us to diversify across a single tenant and not only their credit profile, but the industry that they're in as well. But for flexibility, a fund allows us to purchase some of these properties opportunistically using all cash to beat out other buyers for great assets. So that we like this model, and investors get to benefit from some of those purchases we make.
Thanks, Drew. So a little deeper dive on the sale leaseback here. So ultimately, we work in tandem with private equity executions. So big picture, private equity will buy multiple manufacturing firms. And when they acquire those firms, if those firms come with the real estate, those private equity backers prefer to pull the capital out of that real estate and redeploy it into the operating side of the business, which is how they grow that business faster and make money. So we are effectively their alternative capital partner. We purchase the real estate from that manufacturing firm. We lease it back on a long-term 20-year net lease. And correspondingly, that firm is able to fully pull all the capital out of that real estate, usually pay down long-term debt, clean up their balance sheet, and reinvest it into growth initiatives in the company. So I'll do a quick look here. These are really outlines in a little more detail the type of properties we're buying. So we looked at the map there, all domestic-based, industrial, triple net leased real estate. We buy them singly and sometimes in small portfolios, just depending on the seller there. These are all going to be industrial. It's going to be a mix. Some are going to have manufacturing, some distribution, cold storage, shipping, receiving. Ultimately, from the outside, though, they're going to be agnostic type buildings that can be re-tenanted for a number of uses if needed. These tenants largely are substantial, really tenured firms that have been in business 50, 60 years. Most do over 100 million a year in sales and ultimately have low or oftentimes no corporate debt. And then that lease structure we talked about, triple net leases, those tenants, the firms pay all their own building expenses. And ultimately we have really reliable rent coming in that has annual escalations built into that lease. And then finally, for this fund, as Drew mentioned, we're raising about 60 million in equity. That'll deploy into a little over a dozen properties for a very diversified portfolio. Drew, you want to talk a little bit about kind of our niche for deal sourcing here?
Yeah, we have a really specific niche, and there's a set of brokers in the country who really specialize in this as well. So we have a long-term relationship with pretty much all of them, right? There's a first name basis with all of them. So we have a lot of reputation in this niche for executing and being able to close and being flexible with sellers and being creative in the structuring of the lease and the purchase agreement. So that's been a place where we've executed, and it's brought us more and more deals and repeat business from private equity groups as they buy more companies and spin off their real estate. We're a continuous capital partner for them. So that's really led to deal flow over time from the brokerage side, but also that increasing track record with the private equity group as well.
Thanks, Drew. And so really the underlying securitization of these investments is going to be the strength of the tenant. So we have a full in-house credit team that looks and does a deep dive into this. And ultimately, they're making the bet to say, hey, for the 5 years we plan to own this real estate, how likely are these guys going to stay in business and pay the rent? So on the high level, they look at that tenant credit, overall credit health, and that's going to look at, really year-over-year sales, EBITDA, profitability, what the corporate debt looks like. And then we're going to narrow that down to say, hey, if that tenant owns multiple properties, is the warehouse that we're buying, does this house a profit center for them? And also, is this a critical production facility such that even if they do have to go through Chapter 11 in a worst case scenario, if this is a mission critical piece of real estate, that tenant is likely to keep that lease intact as they restructure and organize. And finally, ultimately, we want to buy these properties well below replacement value. We're paying roughly 50 to 60 bucks a foot. Replacement value in this space is about $130 to $150 a foot. So we are substantially below replacement cost at a very defensible basis. Let's see, I'll cover the fund structure, and Drew, I'll kick it over to you on the backside for the finance. But ultimately, 6-year fund, we're raising about 60 million. We're about 25% of the way through that raise currently. We take checks $75,000 or higher, and that's going to be spread across a diversified portfolio of about 15 industrial properties, fully leased. There's depreciation pass through, and we can talk more about the specific tax pieces, but ultimately tax advantage investment. And we as a sponsor team put in a minimum of 5%, which will equate to about $3 million of equity comes from the MAG team. In addition to that, we're signing personal guarantees on the majority of the debt for better rates and ultimately more flexible ability to refinance if rates do go down in the future. Conservative debt here, all long-term fixed rate debt. So the majority of it's 10-year debt. So we're holding about 5 years, but that gives us options. We can extend if needed based on what the world looks like in about 5 years. Fully audited fund, and we do quarterly distributions and reports. Drew, you want to cover the finances?
Sure. As far as the return structure to investors, we structured it with an 8% preferred return. And cash flow in the beginning, we're going to be between 7 and 8%, but that'll ratchet up over time as these leases hit annual bumps every year. So we'll certainly be going from 7 to probably about 10+% as we hit years 5 and 6 towards the exit. Every bit of profit is split at 70-30 ratio in favor of investors, and a projected IRR is 16%. So a 6-year hold puts us at an equity multiple of 2.1x. Distributions are sent out quarterly, and we're transparent about our GP fees. We take a 1.75% acquisition fee, half to 1% loan fee based on personal recourse we sign on the debt, and 1.5% management on equity. There's no GP clawback. There's no secondary waterfalls. It's a 70-30 split all the way through.
Thanks, Drew. And then finally, last slide here, just a quick snapshot on where we are on this fund. So we've acquired Angie's and KBK, which is a substantial amount of real estate in Maine and Kansas here. Ultimately, coming up on Colbert tomorrow, Colbert Packaging in Elkhart, Indiana will close. And we have about 5 or 6 properties that are currently identified in the pipeline. So as we raise capital, we'll deploy that capital into more and more industrial real estate, give updates along the way. And investors, once that those funds come in, you start accruing a preferred return. In addition, you start taking part in all cash flow distributions from that rent. All right, at this point, we'll open up to questions.
All right, thanks, Neil and Drew. So one of my questions I have in here, when it comes to finding these properties, can you say more about these relationships that you have? Because it seems like this would be hard for someone just to go and find a property that has a sale leaseback attached to it.
Yeah, I'll take that. Yeah, there are brokerage houses that focus on this, and really a lot of that relationship that we have with the brokers out there who control, we see them controlling about 95-98% of that market. These relationships with the brokers go back decades. Neil mentioned the founding principals. Both have been in brokerage for a long time. We like to say they speak fluent broker and understand, how to work with them to ultimately close on the property, which is their job. And again, just having those relationships be strong. I mean, it's started a long time ago. It's been built over time. So reputation has been built over a long time, and being able to show that you can close, not retrade brokers and sellers, and get the job done on time. It really goes a long way when you do it consistently. So yeah, as far as sourcing the deals, brokers do a lot of that. But the private equity groups that we've worked with that they represent a lot of times come back to us off market. So about 25-30% or so of the deals that we do are completely off market, where they bring to us and say, hey, you've executed for us before, we have another opportunity.
And I'll add to that, really the nuance of the sale leaseback means, really the experience is crucial. So you're not just battling it out over price of the asset, but you're also finding the nuance to say, hey, I can have flexibility on how much I pay for that asset in return for changing the lease rate, right? Changing the term of that lease, changing the escalation. So there's a lot more variables in play for that negotiation to find really a sweet spot with that seller who's going to have a long-term relationship with you as your tenant after the transaction.
Okay. So like if some of these early ones that come in and it's a 6-year fund, what happens if, they're all planning to grow, of course. So what happens if they want to expand or do something at that facility, or, can you do something to help them out?
Yeah, absolutely. So, the strength of these investments is that lease. So we're putting in a brand new full triple net lease in, meaning that tenant is responsible for any sort of expansion or capital improvements. However, we come in as a kind of a full service landlord, and we will work with our tenants and say, hey, if you want more room here, if you're sitting on extra land and could use more square footage, we actually have a full development team. Sometimes we'll be able to build out additional square footage or capitalize, heavy maintenance on the buildings, for example, a new roof. And we can actually capitalize that expense into a new updated lease with a higher rent rate, with maybe a longer term, maybe both. And that allows the tenant to enjoy, really an improved facility. It allows us to increase our NOI and overall increase the returns for our investors at the same time.
So how often when they come in, do they already have built in, I want to do this expansion or modification that is coming?
Yeah, I'd say over the course of the hold, 5-6 years, maybe one in 3 tenants will have some sort of improvement or expansion that will work with them as a capital partner on.
Okay, so being vertically integrated starts to become important because a lot of them have some modification, either financial or even physical, attached.
Yep.
Okay. And then what happens on the back end? Like, how does an exit go? Who's buying them, or what happens to that property over time?
Sure.
Yeah, I'll jump in here. Most of these sale leasebacks are 15 to 20 years. So, we're targeting 5 to 6 year holds. So you can imagine, selling an asset with 15 years left, institutional grade lease, absolute triple net. It's a really attractive asset for a buyer. A lot of institutions look at these, and for this fund, we absolutely will have institutional interest. We're talking about $175 to $200 million in assets that are all industrial, all absolute triple net lease with a lot of lease term. They call it the acronym is a WALT, a weighted average lease term of around 15 years. So that's a very attractive portfolio, and absolutely looking to sell because that lease term that's remaining is really the meat on the bone for the next buyer.
Okay. You can accept retirement funds, correct? Something like the self-directed IRA or an alternative like that.
Yeah, Neil, do you want to mention the REIT?
Yeah,
so that was one of my questions, how that works, because I know that comes up as a problem sometimes, how you can address that.
Certainly. Yeah, with the fund, you can do a direct investment into the fund, which generates K1s, really a very common structure through real estate. On our fund, we also have an alternative structure that invests through a REIT. And what that means, really the cash flow is identical, right? So the same returns, same cash flow distributions. However, from a tax basis, that REIT effectively cleanses or sanitizes rental income into dividend income. And it's a choice vehicle for self-directed IRAs and 401ks because it removes any sort of UBTI or UDFI tax implications. It's also really good for investors that prefer not to do multiple state tax filings, as that REIT option produces just a single 1099 tax form.
Yeah. So then in order to do that, what happens when they talk to you? Is it different terms or anything when you do that?
No,
like as an investor.
In the investment process, you have a choice. Really clearly, you have to select either direct investment or REIT investment based on your, and we're always happy to talk more about that.
Interesting. Okay. Now, sometimes you talked about the competition that comes in here, but how do you think you stand out versus one of those big institutions coming in like Blackstone or KKR to go through and make that Mag Capital stands out as a buyer?
Drew?
Yeah, we can get really granular. Try not
sure.
But yeah, there's a lot of flexibility. Yeah, at the end of the day, we're more nimble than some of the bigger ships, and so we're willing to look into sales where there potentially could be a little environmental hair, and we'll work through that process, build in the correct amount of environmental insurance to protect ourselves or indemnity, for instance. So we're not going to take on additional risk, but put in some additional time and effort to work through it. That sets us apart. Neil mentioned being a capital partner to the tenant. That's something that CFOs of these companies love to hear. Hey, you can help us out later. And maybe it's capitalizing a large CapEx item that they're responsible for. And what I mean by that is capitalizing that into a long-term lease. There's $1 million roof replacement. We'll finance that and manage that and reset the term and rate of the lease in order to pay for that on our end, and thereby increasing the value of the property. So, we're certainly not doing that out of the goodness of our heart. We're doing that creating value in this asset, and it's a value add opportunity. So some of these things move the needle quite a bit for a seller. And when they hear that, hey, you can work through some of this stuff, you can be a partner with us over the long term, that really helps us stand out.
Okay. And I think I had a question here too, but the comment, when a company comes into private equity, it's really this idea of what you're doing is you're an alternative in the capital stack. I think is that the right way to put it? Essentially, they're financing an entire deal. They're focused on supercharging the company aspect of it, and you're able to come in and help them finance the section anchored by real estate, really provide a turnkey solution as they grow. Is that the right way to put it?
Yeah.
Them selling the real estate is the alternative to that. It would be to get outside debt on the company or to potentially put a mortgage on the company. That mortgage is going to be limited to 65% of the value of the real estate. It's going to sit on their balance sheet as a long-term liability. By exchanging that for a lease, they're able to have a cleaner balance sheet. They're able to have better access to other outside capital. And ultimately, there's some other long-term reasons why they would pursue a sale leaseback as opposed to traditional debt financing.
Okay.
They have a higher ROI on that capital that's tied up in the real estate. Sure, there's an advantage to owning the asset, but they have a much higher ROI in putting it into the business and growing that.
Right. And then you said your deals, I think you had mentioned in there, your purchase, you're usually doing like 60-70% debt. Did I hear that right? And the rest equity as you go, but sometimes all cash if you need to.
Yeah,
Right.
it's very topical.
That all cash is usually used just to acquire the property, maybe went out, and then typically we'll add debt afterwards.
Okay. All right. I think we're pretty close here on that. I know we're getting close on the time. There's always interesting questions. I've seen this for a while when you were doing these individually, right? And that's where I first heard about you all to go through. I think Neil and I had a conversation going through, but now to have success on the first fund and now the second fund going through. So it's great to see Mag Capital and great things. It's something very different. A lot of times we'll see multifamilies and different opportunities. It's nice to see a sale leaseback triple net lease opportunity on some industrial space. So it's nice that that we're providing the opportunity that people can invest in it. You all are doing something a little bit different than you could find out there. So appreciate both of you coming in here. So now though, I want to switch over and talk about our second company. So thanks Neil and Drew for coming in. Oh, by the way, if we'll put into the chat, there's this final page here. You can grab Neil's contact information. We're going to drop it in here as well. And we also have our deal tile that you can go and look at the deal. There's some more information that might not have been here on the page if you want to peruse that as well on Localvest. All right, but now we have a couple of polls here as we pull up the information on the next one here. All right, so for our second company, this is a very different thing. We're in the consumer goods space, and we have with us today for Woobies is Mason. So Mason's the CEO at Woobies, and it is a company that develops and sells purpose-built technical footwear and apparel for active military, veterans, and protective services and the everyday elite consumer. So Mason is a former enlisted, I guess always a Marine though, so go through in the Marine Corps in 2007, spent 8 years in service, which include deployments to Afghanistan and throughout the Pacific. And then in 2018, he pursued his MBA. And while he was doing that, that's where he met the founder of Woobies, Anthony. And he quickly realized that Woobies was his new calling. And in Woobies, they've taken audacious actions to sustainably grow the company, and they're committed to providing the best products and customer service in the industry. He's doing all he can to make an outstanding culture and create the best product and customer support. So I welcome Mason and look forward to hearing everything about Woobies.
Thank you very much, Jake. Let me see if I have control.
Mhm.
Okay. Like Jake mentioned, Mason Hamlet, the co-founder and CEO of Woobies. Woobies is a shoe and apparel company. I'd like to direct you to the gentleman, one of our first brand ambassadors on the screen. Derek Carver lost his leg in Kandahar in the early 2000s. Underwent many surgeries to become the world's strongest amputee. And Derek represents what will be the ethos of Whoopies, which is veteran supporting veterans and everyday elite. And that's what we strive for with our products and with our brand. So who is our customer? We feel we identified product market fit in a very large and underserved market that has a very good wallet size. And this 33% of our customers buy again from us every 3 months. That's well above the industry average. And it shows the affinity that people have towards our brand and towards that everyday elite and veteran supporting veteran brand that we have. So how do we kind of develop our product roadmap? Is through we analyze a lot of the analytics and a lot of the feedback from our consumers to drive that in the future. So we identified product market fit with the Mod 1 low top, and we're heavily analyzing data of our customers to provide them the products, the shoes, the features they need. So we're very data driven in our product roadmap, so they can what we call work, protect, play. So what are our shoes? Right now we have the Mod 1, Mod 2, and we'll be releasing a limited edition Jungle Boot in the near future. So we have a pretty good sell through on all of these. I'll go into a little more detail here. So the Mod 1 was the first shoe we launched January 31st, 2020. Immediately found product market fit, and we call this the sneakerization of the tactical boot. So it has some military features on it that give it durability, comfort, but it's also a shoe that you don't have to lace up to, almost to your knee, right? So it's a balance between the two. And then we launched last year around September. We launched our newest shoe, the Mod 2. And anytime you launch a new product, it's we did a lot of analytics, a lot of data, but we really knocked this one out of the park. We achieved a nice 93% sell through on the initial launch, and this is our highest margin item. So right now with both shoes, we have 4 colorways and 2 camo colorways, and that's what we have there. The Jungle Boot, we have a few other of these kind of in the pipeline, and this will go into when I go talk about our marketing and collaboration and partnership strategy. But this would be something that we would release probably around D-Day or an event around Vietnam to kind of build a huge marketing and media campaign following up to this, do a limited drop, and have a kind of a blowout sell in 48 hours on a high margin item. So one thing that we noticed when we kicked this thing off in 2020 after the founder and I graduated SMU was we were very fragile. We were very fragile through our supply chain, right? We had one manufacturer. They were sourcing some things out of Asia. A ship gets stuck in the Suez Canal, or the port at Long Beach gets backlogged. We didn't have product, right? So we'd have to pay for air freight. So one of the big focuses early 2022 was to diversify our supply chain. So I lived in Colombia for a while, Nicaragua, and then in Spain. We found a very good high quality supplier that can scale with us, but we don't want to just rely on one factory. I just received our confirmation samples from a Dominican Republic, our strategic alliance with the factory there yesterday. It's an outstanding shoe. It's very promising, but the ultimate goal with this gentleman who owns factories in Nicaragua, Dominican Republic, and Tennessee is to build the line in Dominican Republic at a reduced and have reduced COGS and transport that into Tennessee. And I can get into how we make that happen. We can achieve scale at a lower cost and prove that we can still make things in America and win. So we have a strategy to do that. And as soon as we do that, that really unlocks the B2G and the wholesaling strategy, because we'll have the margins to support it. So I'm going to get into the partnerships and marketing and how we really draw a lot of organic to our site, right? And this is some of the secret sauce behind our marketing is we're able to draw organic traffic through these partnerships and collaborations, reducing our customer acquisition cost substantially. Even like with Joe Rogan post a photo with him wearing our hoodie or our shoes, but we're pretty intentional on how we map out, going with the veterans, supporting veterans. Last year, we did a partnership with the Heroes on the Water. It's a suicide prevention nonprofit, and the Honor Foundation, which is for transitioning Navy SEALs. We did a partnership t-shirt, a shirt, and a sweater with both of those. 70% of the proceeds went back to that organization. We highlighted it on our social media channels, through our email list, through theirs, to bring awareness to these causes, right? And also help with our product development as well. And another one, the last 2 years, we've been participating in with the Baltimore Ravens. A gentleman on our team was a linebacker for them on the last Super Bowl winning team. So we've been working with the front office for the last 2 years to participate in their Salute to Service Week. The NFL right now is doing a lot of rebranding after some of the kneeling and some of the things that took place, and their pathway to do that is to do outreach with veterans. So we have a plan with not only the Baltimore Ravens, but with NFL Players Association to help sponsor events, to work with some of these nonprofits to bring awareness to WOBIes, to the nonprofits. So it's a win-win. So this is kind of what our partnership and collaboration roadmap looks like. And this is how we reduce that customer acquisition cost, and we bring in that organic traffic that we can convert, that we don't have to pay Mark Zuckerberg for Facebook ads, right? This is just starting off in the year, NFL Players Association partnership. As we get later on, we're going to be doing some stuff with some first responders. Veteran artist is another big one. Ed Manifesto, he's been on Joe Rogan several times. Ed Calveron's his name. He was a CIA kind of cartel hunter in Tijuana, so we did some products with him as well, and some other veteran artists, right? And then other kind of product collaborations would be with 22 Jumps. It's a nonprofit for people that like base jump, essentially Heroes on the Water again. And then as we go into Q4, that's really when we do the Salute to Service of the Ravens. It's Veterans Week, that we try to own that week, and then participate in Toys for Tots and some other homeless veteran nonprofits. So where do we sit among the competition? So when I say the sneakerization of the tactical shoe, there's been several companies that have tried to kind of match this market, but they kind of come up with a very tactical shoe that's not really practical in everyday life. Our shoe is something that a nurse can wear and stand up in all day, or a cop can wear and stand up in all day, or you can wear, I wear mine with a suit, when we go places, right? But it's also a shoe that you can, power lift in or do CrossFit in. It's a very functional shoe. So what I'm trying to represent here is we're capturing the features of the military, right? But we're making the shoe more approachable. And I can get into these, anyone has any questions on how we make this more approachable in the future. So here's our plan, essentially for till 2025. Right now we have the Mod 1, Mod 2, and those colorways. I just received also a prototype of our work boot with the steel toe and all the requirements of a work boot that we feel we can get B2B and B2G contracts with, as well as sell on our site for a high cost. We'll be dropping more apparel. We have the jungle boot limited edition that we could repeat that drop at different times with different variations. The athletic partnerships, as I mentioned, and as we start getting reduced COGS and scale in our manufacturer, we will enter wholesale, and with that ultimate goal of having an American-based factory. And then as we get into late 2025, international expansion. So here's our B2G roadmap. Right now, the FBI SWAT team in Houston is wear testing these Mod 2. They have been for several months. They were wearing Solomon. So we're doing a test run with them. And then upon successful completion, we would secure a contract. I got off the phone with the head of procurement for Texas DPS on Monday. I met him through a nonprofit event for the Semper Fi Foundation a few weeks ago. We're going to do a trial run with their top tier SWAT team for Texas State Trooper to try to secure that contract as well. We feel we can provide a very competitive shoe for that Mod 2 high top. It's essentially a shoe that SWAT teams really love to wear. My friends actually got me into the Houston SWAT team. That's where we got kind of that initial contract, right? They wear it on high felony takedowns daily. But here's who we're targeting. This is the Border Patrol, TSA, and then ultimately the VA, the Veteran Administration. And another thing I'd like to mention with the B2G and the B2B is right now we're 100% direct to consumer. So all of our revenues are 100% direct to consumer. So direct to consumer is it's a very unpredictable space. We're constantly reforecasting. Our plan is to have that by 2025 direct to consumer account for about 30% of revenue. So we're trying to not only diversify the supply chain, but diversify our revenue streams over time so we can lock in these contracts, and it'll help us scale our manufacturer, and it'll build rigidity within the business. That's not 100%, 100% kind of tied to consumer behavior, which is difficult to predict. So here's the team. We have myself. Jake mentioned I was a Marine for 8 years. During my time at business school, I helped take a fintech startup. They sold to a large bank. Brady Beaucamp was a submarine officer. I worked at Goldman Sachs afterwards for several years, could help close a large real estate deal there. And then he was in venture out in California for several years before he joined Woody's. Alan Wynn, our growth guy, he helped take Beats by Dre. He launched that product. The latest thing he did before Woody's was take Playboy public by developing an acquisition strategy and bolt that on. But he's essentially our growth guy. He's done several of these direct consumer facing products, and we feel he's one of the best in the industry. And we have a very sophisticated marketing plan for this year. And head of partnerships and collaborations is Edgar Jones. He's the gentleman that got us into the Baltimore Ravens, as well as he's the lead guy with the veteran nonprofits as well. So about 90 days ago, we kicked off a seed round. We raised almost half of it, and we're looking to close the round. We have about 1.2 left. We have some founder stock available. Yeah, that's Whoopies.
All right, thanks, Mason. I think if you can bring up the picture, I have a question I wanted to start off with here. All right, so you mentioned Joe Rogan, so I'm going to put this picture up here. The question is to kick off here, how in the world did you do this? My understanding is Joe Rogan, he's careful about what he puts on because he knows that it's broadcasting that brand. So how did you do this?
Well, it's a great question, and it's people ask me this all the time, right? This was very deliberate. This took a long time to build this relationship. The founder, Anthony Ageniga, he was a Green Beret 7th Group guy. So he's been building this relationship with Joe for quite a while. They know some of the same people, right? And so it was something that took a long time, and we kind of had to work the network around him to get to him. But the credibility that Joe brings is you're right. He doesn't associate with any brands that he doesn't think that are for real. He has a huge affinity towards veterans and veteran companies. So the problem with him is, though, like if he posts, we need to, if he posts our shoes, we have to be very careful that we don't completely run out of inventory, right? So we have to be very methodical on how we do these activations. But it's there, it's available. And yeah, but it was very intentional, and it took quite some time to get that.
All right. So what you're saying is I cannot just send him a sweatshirt and he throws it on.
No, I think he probably has about 500 boxes in his office every day from product companies, right? So no, it's an advantage we have.
Very interesting. Okay, you mentioned early on one of the things about where you stand with competitors, and you talked about this idea of becoming more approachable. So can you explain more about what you mean by, like, how does a shoe company or a brand become more approachable?
No, absolutely. Yeah, that was a great question. So when I said we found product market fit in this underserved market, it's because it's an approachable shoe. And that meaning, what I mean by that is a shoe that the school teacher can wear, the kid playing Call of Duty can wear, the skateboarder kid. It's a very functional shoe that a lot of the other competitors, when they tried to make a tactical shoe, they put, the 3 Velcro straps on it in a pocket somewhere, and it just screams tactical, right? And it's not really, you can't really wear it around unless you're, really just, going hiking or something, right? So when I say more approachable, that we want a shoe that that the moms can wear, that the wife of a first responder, that the kids can wear, that can perform a variety of functions. So that's what I mean by incorporating the tactical features, but not so much to where you can't wear it every day, right? So that's how we're getting there.
Okay. Now, I don't think there's another thing you mentioned there, B2G, which maybe I'm out of my marketing stage to go through, but I don't think I'd heard that one before, but makes sense. So you're essentially going after the governmental groups to turn those shoes into essentially their uniform wear, right? Or an option to wear with their uniform.
Yep.
But there's a lot of different ones. How are you approaching which companies you go after, or which groups you go after in that space?
Great question. So what we've decided to start with is the SWAT teams.
Mm-hmm.
Reason why is because SWAT teams operate essentially the same way as an ODA or a SEAL team. They have discretionary funds, and we have a lot of credibility with those commanders. And so I'm going to be going to a SWAT team event in Austin next month. So that is our plan, and typically every town has a SWAT team. So that's our plan to break into that. And another reason on the marketing side for that is the same with the Navy. When the SEALs started wearing the Gator sunglasses, everybody else in the Navy started trying to wear those sunglasses. So in the police and the firefighters, law enforcement, whatever the SWAT guys are wearing, is kind of what those guys want to wear. So it's kind of a two-pronged approach to gain B2G contracts, but also to just populate, how cool the brand is and the shoe is.
All right. And then I guess the same question too on the partnerships, the types of partnerships that you had an ambitious one, but what are you thinking about when it comes to the right partnerships for Woogies?
Yeah, we do a very methodical, kind of interaction with these partnerships. I think the next one would probably be the Simplifying America's Fund. It usually will do something small, starting out with a discount code, and we'll kind of get to know each other, because we don't want to get tied to a nonprofit that has some type of bad press come out, right? So we're pretty methodical on who we partner with to make sure that it's a legitimate and it's a good cause, and that they're appropriating their funds correctly. And then we do the same for us. We have to prove on our end that we're for real as well. So it's a powerful tool, because we do have a large social media following and email subscribers. So we feel that it's a win-win. Another one that we're targeting is the American Legion. We feel that we've done some stuff with the American Legion, but we think there's a way we can develop a strategy with them long-term over all of their legions across the US. So we've talked to a few people there as well, but it's a process of kind of a back and forth before we decide on who we work with.
Okay. Now, you had said both of those things, like diversifying the revenue stream, but I mean, most of us, I think, here, like direct to consumer, that's like nirvana, like what you're going for. Like, this is the promised land of going through. You don't have bricks and mortar store, but you were saying before, before we went on air in our prior talks, that's not always as great as it seems. I wonder if you could tell everybody else a little bit more about that.
Yeah, direct to consumer online is very challenging, because consumer behavior and macro conditions change D2C pretty quickly. Like, we're kind of on the ground front of consumer behavior. And we have to reforecast quite often to or go after different cohorts of people in our marketing to adapt to the strategy. And as we grow our funnel, our demand changes, right, for sizes and colors. So it's a difficult channel to manage, but we're good at it, right? We managed it. We spent off about $3 million last year in revenue, just D2C, right? But having that, having the rigidity of B2B and B2G, having both of those where we're wholesaling and we're selling to governments. Yes, we'll take a haircut on our margins, but it's going to expand our manufacturing capacity, expand our revenue, and it's going to make us more kind of recession proof, right? That we already feel that the business itself is somewhat recession proof because of our customers, but layering in those additional revenue streams would just bring more rigidity to the business model itself.
So essentially, like the model, what you're doing today is you have to place that big order. It's got all those different sizes. You got to place that order, and then you're out. And you use the marketing flywheel that you have with all your followers, and then you sell out, and it's like feast or famine. It's a way to put it.
It's a good way to put it. We're making some strides with our supply chain management to reduce that cash conversion cycle down to like 21 days. So not just in time inventory, but we can get really precise on a 3-week timeline on demand, and then we can prioritize those at the factory level and have those air freighted over, because we're having air freight now just to keep up with demand. But eventually, going back to those traditional channels, B2B and B2G, they place large contracts. They're financeable, and so that's much more appealing, for us to scale, as opposed to us having to pay 100% of the shoe on the front end, bringing it over here, having the dry powder on the marketing side to move and go from there. So it's a very capital intensive industry when it's only direct to consumer. It lessens that intensity as we bolt on these additional revenue streams.
Very interesting. So yeah, a lot of the funding, then that's what it's going to help you do, is to expand out not only to the direct, but to go into those other markets.
Correct.
Very interesting. All right. I know we're getting close here on time, so I need to start wrapping some things up. I will say, if anybody wants to reach out to Woobies, we'll put some contact information we had on the screen, but we'll also drop it in the contacts, and you'll be able to make that connection as well.
Okay.
Okay. The other thing I do is we have another poll here put out. If you have interest. Now, for everybody here too, is we are going to send the recording out to everybody. We'll also have all the contact information, the deal tile as well. There's some more information there as well for Mason, and then also going back to Mag Capital as well. So on our end, I will tell you, we do have our next launch with Localvest coming up. We have a couple of companies. I won't tell you the companies are there yet in there, but we've started to finalize those out. You'll start to see, but it is on Wednesday, April 12th. Another Wednesday here at lunchtime on the Eastern time zone. So for those of you though who are interested, there's a lot on the Localvest site. So if you go and log in there, you can see a lot of different deals. If you haven't logged in a while, there's actually a lot of opportunities, some new features that are in there. If you haven't seen that, I encourage you to go in there. And then if you see anything that interests you, if you want to talk to these gentlemen here about their opportunities or any other ones you see, it's easy to go in there and click on it, schedule a time, and do a one-on-one conversation and ask them the things that maybe I didn't get today you wish that I would have asked. So I encourage you to do that as well. So I want to thank everybody for attending today. I wish you all a very good rest of your day. I will tell you, here in the DC area, the cherry blossoms are coming out. It's a little cold day, but springtime is coming. I know some places are already warm to go through, but it's great to have you all joining us here today. We hope to see you again next month, and have a great rest of your day.
Thank you.
Thanks, guys.
Thanks.